After studying this module, you shall be able to 1. Know the meaning of financial management, 2. Identify the scope of financial management, 3. Learn various functions of financial management, and lastly, know the different types of financial decisions. Financial management was a branch of economics till 1890. But after that, its importance grew and it was realized then and evolved as a dynamic and an important subject. Financial management deals with the financial decisions making. It is primarily concerned with planning and controlling the financial resources of an enterprise. It encompasses procurement of the funds in most economic manner and utilization of the funds in most effective way. There are no executive development programs titled production management for non-production executive or marketing management for non-marketing executives and so on. But there are books and programs titled finance for non-finance executives. The reason is obvious. The common thread running through all the decisions taken by various managers is money. The research and development manager has to justify the money spent on research. Materials manager has to keep optimum level of inventory in stores. If he keeps more inventory than required, he is storing money without returns. Similarly, advertisement requires outflow of money. So sales and marketing division has to justify the expenses. So almost all activities in the organization have financial implications. Therefore, finance manager is involved in most decisions of the organization. Evolution of financial management. Financial management evolved over the past 50 years. Initially, as we said earlier, it was a branch of economics. It has emerged as distinct area of study during second half of the 20th century. The evolution of financial management is divided into 3 phases. These 3 stages of its evolution are the following. 1. Traditional phase. In this phase, finance manager was concerned with only record keeping, preparing different reports and managing cash. He was called upon for his specialty for sporadic events like promotion, amalgamation, reorganization, expansion and liquidation, etc. To manage funds for these events was considered an important function of financial manager. The trend continued up to 1950s. This approach had its own limitations. 1. It was primarily concerned with procuring of funds only. Therefore, it was a one-sided approach. Secondly, the approach focused on corporate enterprises. Non-corporate entities like sole traders and partnership firms remain outside its scope. Thirdly, it placed more importance to particular events like incorporation mergers, consolidation, etc. And therefore, the financial manager was called upon to exercise his skills only in these important events, not realizing that the finance manager's function is an ongoing process. Fourthly, this approach placed more importance on long-term funds. It ignored that funds are also required for short-term needs and the emphasis on short term was ignored. Second, transitional phase. During this phase, importance was given to the problems faced by the finance managers. The problems related to funds analysis, planning and control were given more attention in this phase. Thirdly is the modern phase. The role of finance manager changed and scope of finance function widened with time as there was increase in completion and growth in business. The finance function was not restricted to just procuring funds and only at episodic events, but the need for optimum utilization through analytical decision making was also felt. Now, a financial manager procures funds, takes decisions on allocation of funds by analyzing various projects and monitors the results of his decisions. He deals with variety of situations in any organization. He has to counter inflation and hedge foreign exchange exposure. Financial function not just had a broader view, it also became a continuous function. Financial manager today has to decide upon capital structure by analytically finding that level where the cost of funds is minimum and the value of firm is maximum. This approach overcame almost all the limitations of the traditional approach. The finance function became a continuous activity. Focus was not just on long-term funds but also on short-term funds requirements. It became a more analytical and dynamic activity rather than a passive job of procuring funds only. It may be noted that this modern phase is still going on. Functions of financial management. As the scope of financial management was limited in the traditional phase, the function of a financial manager was also limited to the procurement of funds. Whenever funds were required in the organization, the finance manager was called upon to arrange them in the most cost-effective manner. But with the advent of modern phase after 1950, the function of financial manager also widened. Since finance is linked with all other functions in the organization, that is production, research, marketing, etc., the finance manager's presence is required at every moment whenever any decision involving funds has to be taken, whether it is raising funds, utilization of funds or distribution of surplus funds. Finance functions therefore includes 1. Investment decisions, that is capital expenditures decisions which are long term and working capital decisions which are short term. 2. Financing decisions, and 3rd, dividend decisions. These functions are performed simultaneously and continuously in the normal course of business. They do not necessarily occur in sequence. In addition, he is also responsible for financial planning and control. The financial manager acts as a link between the organization and the capital markets. Investment decisions. Firms have to allocate their scarce resources. Investment decisions can be classified into 2 broad categories. One is long-term investment decisions and the other is short-term investment decisions. The long terms are also called as capital expenditure decisions, whereas the short terms are called as working capital decisions. Capital expenditure decisions. Now this involves the decision of allocation of capital to long-term assets, For example, whether to buy a plant and machinery or not. These can be accept and reject decision, where a particular project is taken up or not. Or these can be mutually exclusive decisions, where the decision taken is one amongst the available options. Another type of capital expenditure decision is as to time when the plant must be replaced, called as replacement decisions. Before taking such decisions, profitability of new investment must be evaluated. The profitability is evaluated by discounting future benefits at an appropriate cut-off rate. That is, the rate at which the discounting has to be done, which generally is the cost of capital to the firm or the minimum required rate. This could also be the opportunity cost of investing elsewhere. But there are two main problems associated with the decisions. Firstly, the future benefits are uncertain as they have to be predicted right away. So there is always an element of risk. Secondly, the cutoff rate cannot be exactly determined. Working capital decisions, that is the short term. Just like investment in long-term assets, investment in current assets also has to be evaluated. It is important that current assets are managed effectively for protecting the firm against the danger of illiquidity and insolvency. While managing current assets, there is trade-off between profitability and liquidity. If you invest excess money in current assets, the assets may remain idle and profitability is foregone. In case the funds are not invested in current assets but invested elsewhere to generate profits, there is a fear of disruption of normal operation of a firm. In working capital management, each and every component of the working capital has to be managed. This means management of cash, management of receivables and management of inventories on the current asset side and management of payables on the current liabilities side. Financing decisions. A finance manager has to arrange funds for the organization. For this, he has to see that these funds are arranged in best manner. This means that the source should not be very costly as well as there should not be much risk in funding through that source. After considering each individual source, the composition of all the resources in the total capital should be a balance of risk and cost. Therefore, the decision deals with the financing pattern of the firm as well as the sources of funds which have to be used. It decides when, where and how to acquire funds to meet the investment needs. In financing decision, the most important issue is to determine the proportion of equity and debt, which is also known as capital structure. Increase in debt increases the return on equity provided. Rate of return in the business is higher than the rate of debt. But it also increases the financial risk of the business. Equity has the benefit that there is no commitment to repay the capital, nor fixed return has to be paid even if there are substantial gains. The debt has to be served by paying regular interest as well as repayment of principal, whether or not the business is generating profits. Dividend decisions. This decision determines the appropriation of after-tax profits of the firm. The profits that remain after tax can either be distributed to the shareholders in form of dividends, or they can be reinvested in the business. The decision has to be carefully taken. If more dividends are paid, reinvestment will be less and growth slow. If less dividends are paid, the shareholders' expectation will be unfulfilled. Paying will also mean outflow of cash. Legal provisions have also to be looked into before making the decision. The finance manager may also decide to distribute dividend in the form of bonus shares, as it will not necessitate the outflow of cash, and the shareholders also feel satisfied. If the shareholders are interested in having cash, they can sell their bonus shares in the market. Financial goals and objectives. A finance manager must have some goal or objective which should be the firm's goal, in the light of which he has to take decision. The goal will provide a direction to the finance manager in analyzing different decisions. The goal is generally defined in terms of maximizing some function or variable. The variable should tend to maximize the economic welfare of shareholders. In order to take the best decision in the direction towards achieving goals, it is necessary that the goal and objectives should be well defined. That is, they should be clear and unambiguous, and they should come with a clear and timely measure. This will help in performance measurement of the finance manager, and his decisions can be evaluated in the light of these available benchmarks. There are two approaches in this regard. The first is the profit maximization approach, and the second approach is the wealth maximization approach. Profit maximization approach. As per this approach, a finance manager should undertake all those activities which increase profit and avoid those activities which reduce profits. This will result in optimum utilization of scarce resources. It will not just benefit the firm but entire society. The approach is not without limitations. Following are some of the limitations of profit maximization approach. There are many parties involved in the firm. There are employees, creditors, management, and shareholders. Sometimes they have conflicting interest. For example, if higher wages are paid to the employees, the profit of the organization declines. So the manager has to do his best to reconcile the interest of different parties. The second limitation is that it is a vague term. What does profit maximization precisely mean is unclear. Profits can be short term or long term. They can be profits before tax or profits after tax. Does it mean total profits or operating profits? Similarly, it ignores time value of money. It does not consider that profits are coming after some time and in later years. These are considered as good as profits today. So this approach ignores time value of money. There is risk. Decisions are taken thinking they will yield maximum profits in future. But future is uncertain. So there is risk. This approach does not provide any methodology to discount risk. Wealth maximization. The objective of wealth maximization of shareholder is an appropriate criteria to make financial decision. The approach maximizes the net present value, that is wealth. A decision that has positive NPV creates wealth and is undertaken, whereas a decision that generates negative NPV is rejected. The net present value or wealth is based on cash flows. So this approach automatically addresses two problems which were present in the profit maximization approach. These are, it is not vague as cash flows are very specific, unlike profits. It takes into consideration the time value of money. It gives less weightage to the cash generated at a later point of time in comparison to cash generated today. The third problem of risk is also addressed to some extent as discounting is done taking appropriate discount rate considering the level of risk. If the level of risk perceived is higher, a higher rate of discount is used to calculate the present value of cash flows, thus automatically addressing the problem of risk. But this approach is also not without limitations. One, the wealth maximization implies the increase in the prices of shares. So as the financial managers takes correct investment decision, financial decisions and dividend decisions, the price of share would increase. But capital markets are not always efficient. The effect of a decision may not be reflected in the price of a share. Besides, there are other factors which influence the market price of a share. Profit maximization versus wealth maximization. The profit maximization goal tends to increase the overall profits of the firm. It does not consider the risk or time value of money. It makes no difference whether decision increases or decreases the earning per share. Whereas wealth maximization considers cash flows, impact of dividends, earning per share, etc. It considers the time value of money and uses higher discount for more risk. Since the company or firm is owned by shareholders, the finance manager has to strive to increase the wealth of the shareholders. Therefore, the maximization of shareholders' wealth as reflected in the market price of a share is the basic goal of financial management. The profit maximization can be considered as a part of the wealth maximization objective, but it should never become more important than wealth maximization function. Let us take an example. Suppose there are two products X and Y and their projected earning over the next 6 years are shown below in the table. In the first row, 1, 2, 3, 4, 5, 6 years. In the second, product X, and in the third, product Y. We can see in the 6 years, the product X earnings are 80,000 per year and the total are 4,80,000. Whereas for product Y, it is 85,000 and the total is 5,10,000. These are the projected earnings. The profit maximization approach is concerned with more and more profits. Therefore, this approach will favor product Y over product X as it will generate 30,000 more over a period of 6 years. If product Y is more risky than product X, then the decision is not as straightforward as the figures seem to indicate. It is important to realize that a trade-off exists between risk and return. Stockholders expect greater returns from investments of higher risk and vice versa. To choose product Y, stockholders would demand a sufficiently large return to compensate for the comparatively greater level of risk. Profit maximization does not consider risk or uncertainty, whereas wealth maximization considers both risk and uncertainty. Let us summarize. Financial management was a branch of economics till 1890, but after that its importance grew and was realized, and therefore this evolved as a very dynamic and important subject. Repeat. Financial management deals with financial decision making. It is primarily concerned with planning and controlling the financial resources of an enterprise. There are two approaches to financial management or finance functions, namely traditional approach to finance function and modern phase, which came after 1950. The traditional approach to finance function, the finance manager was concerned with the record keeping, preparing different reports and managing cash. He was called upon for his specialty for sporadic events like promotion, amalgamation, reorganization, expansion and liquidation, etc. In modern phase, that is after 1950, the role of finance manager changed and scope of finance functions widened with time as there was increase in competition and growth in business. The finance function was not restricted to just procuring funds only at episodic events, but to ensure optimum utilization of funds through analytical decision making. As the scope of financial management was limited in the traditional phase, the function of a finance manager was also limited to the procurement of funds. But with the advent of modern phase after 1950, the function of financial manager also widened. Now the finance functions include investment decision, financing decisions and dividend decisions. Investment decisions are related with fixed assets called as capital budgeting decisions, and also to current assets called as working capital management. Capital expenditure decisions are the long-term decisions involving allocation of capital to long-term assets like plant and machinery, etc. Working capital decisions are the short-term decisions related with investment in current assets. Financing decisions are related with arrangement of funds for the firm. Dividend decisions determine the appropriation of after-tax profits of the firm. There are two objectives of the financial management. One is maximization of profits of the firm and the other one is maximization of shareholders' wealth.